and welcome along. This is the fourth wave of energy incoming July 10th, 2020. This is day 7th, Sunday, July 12th, 2020. I'm going to bypass a lot of the slides really quick because of the amount of information that's actually in this. I'm going to pass through things pretty quickly here. The 12 watch areas we added Sunday, July 12th, information. We also added the jet stream in, the ring of fire. Again, if you want, you can go back and you can look at the video once more, and you can follow along with the slides that go along with the blog post. But because of what's actually going on with this dream vision and the amount of information that I must release, you can see that I added in the big graph there on Saturday, July 11th, yesterday there. So this is Dream Vision Part 2. So you haven't watched Part 1, it's recommended to do that as well. So this is the American Flag Torn, or 88 American Flag Torn Dream Vision, the Part 2 of it. And it's kind of, it's morphing into a lot of different things. And so this is connected to some type of major real estate crash where people may not even understand that it's actually happening, or they could be in the midst of it or whatever. And then the dream vision changed to panic on Wall Street and people with tickets that are worthless, and then people trying to march and protest and say, what's going on, why does this have to happen? And then it shifted into the US stock market, massive crash, and then it showed something to do with credit, that basically became non-existent, or it was all wiped out or something, and people are just running all over the shop, and it was kind of like chaos, you know. So that's kind of like, notice that it's all in black and white, so it was bringing me in the vision, it was bringing me back to like the Great Depression or something. So this is a very important audio to have a listen to. So what happened as the stream vision was going on, I was like, okay, well, can I maybe find some snippets to give people some perspective on how this can all be connected. So let's take a listen.
Part 1 of the mortgage forbearance program was April, May and June of 2020, which we're coming to the end of right now. I didn't think there'd be a problem at this stage, and there hasn't been, because there's still 90 and actually even more room to go in this program. Part 2 then is this next 90 days, comprising of July, August and September of 2020. This ends the first period of mortgage forbearance, that initial 180 days, taking us to the end of this first cycle. This could result in a number of houses going back onto the market as people simply cannot afford to make the payments. I don't think we're still going to have a major problem at this stage, but we probably will see some of these houses come to market during this period. Part 3 then is the final stage, the final nail in the coffin, which is the second part, the second period of 180 days. So this comprises of October, November, December of 2020, and then January, February and March of 2021. If the crash is going to happen at any time, it's probably going to happen in this period, right in the heart of this period. So if I had to take a guess at this, I would say you're probably going to see it somewhere between December and January, December 2020, January 21, but it could even start as early as, say, October, November 2020. But as we know, the government and the Fed are doing their best to keep this show on the road with mortgage forbearance programs, which could even get extended, or printing of more currency, not money, printing of more currency, or just digitally injecting more currency through stimulus into the economy. So just because we haven't seen a crash by April of 2021, it doesn't mean that it isn't coming. It's just been delayed. Or it could have showed up as another economical marker, such as high inflation, where the value of your house has actually gone up significantly, or should I say the price has gone up significantly, but the value of your house pretty much hasn't changed. Now let's come on to what the biggest problem is here now, and I'll use an example to illustrate this. I want you to imagine a freight train pulling hundreds or even thousands of tons of cargo across a train line. And let's say this train is doing 60 miles per hour. The train doesn't start at that speed. In fact, when it first tries to get going, it uses all of its energy, all of its strength, just to move even an inch. That is an example of our economy right now. It takes a lot of effort to get going, but what we've done is we've just put something right on the tracks, and the train has had to do an emergency stop and just slam on its brake and come to a complete halt. But guess what? The train can't just get back up to 60 miles per hour instantly. No, it has to start at trying to move 1 inch all over again. And this is the biggest challenge we have right now. So if you found this video overwhelming so far, I'm just going to wrap it up now. I'm going to give you 3 final points or indicators to look out for so you know when the market is going to turn. Number 1, we've already covered. This is when the mortgage forbearance ends. This is when we're going to see some issues. Number 2 is interest rate rises. I can't see this happening for a very long time because it would pretty much bankrupt the US government and other governments around the world if interest rates did go up. So I can't see that happening. So which only leaves the third option, which is the lack of inventory turning around. Once you see more houses going onto the market with people panic selling, trying to get out before the crash, this is when we're going to see a crash that could be historically the worst ever seen in the history of our planet. There's only one reason I can see why houses won't crash at the end of this period, and that is because of all of this quantitative easing, this currency creation that's gone back into hard assets. So it could go into hard assets like housing, which artificially pushes the prices up, making everyone think their house has gone up in value. This is also a possibility. If you
economy and stock market could crash on July 31st or August 1st. Well, as noted in the same article, Senator Majority Leader Mitch McConnell said the Senate may wait until the end of July to start work on the bill, meaning if a second stimulus check is approved, it's extremely unlikely that any checks would be sent out for the dates that we're discussing here, July 31st and August 1st. It gets worse because evictions will be returning at this time as well. A federal law that bans evictions in any properties financed by federally backed mortgages, which is more than a quarter of all households according to one estimate, expires on July 25th, just a week before millions of people's main economic lifeline is pulled. And as millions of people experience a sudden collapse of their income at the very moment their landlords are allowed to start kicking them out, other bills will also come due. Payments on millions of poor student loans will begin again at the beginning of October. And shortly after that, more than 4 million homeowners who received a 6-month pause on their mortgage after April's mass layoffs will need to start making payments again at the end of October. So, in other words, federal government help is due to run out for the unemployed on July 31st. A second stimulus check, even if approved, is extremely unlikely, almost certainly not going to happen by this date, while evictions can begin again on July 25th, and just 3 months after, student loan payments and mortgage payments will resume. Now, remember earlier when we saw that consumer spending had collapsed in spite of incomes rising? Well, what do you think is going to happen to spending when people are earning less and paying higher bills? It certainly doesn't look good. Now, from my research, there are proposals for future government help. For example, Senator Rob Portman proposed a temporary $450 weekly payment on top of your weekly paycheck. This retroactive benefit could award you for going back to work before July 31st, instead of remaining on the unemployment roll. The plan is still being finalised, in part to work out the best mechanism for delivering the aid to workers. In its current formulation, the proposal would give $450 a week to laid-off workers to go back to work through July 31st. eligible recipients might see a back payment for the number of weeks between July 31st and when they stopped receiving the $600 benefit. So from my understanding, this would mean that individuals who go back to work will receive an extra $450 per week on top of their regular salary as an incentive to rejoin the workforce. And as the article notes, a bill like this would only help those who were unemployed and then returned to work. So this wouldn't really provide a stimulus to combat the negative forces we've talked about around July 31st. Another proposal put forward by Kevin Brady proposes two $600 weekly back to work bonus payments, with Brady describing this as a $1,200 hiring bonus. Like Senator Portman's $450 a week idea, Brady's $1,200 benefit is on top of your weekly earnings. In its current form, recipients will be able to claim the bonus if they return to work before July 31st. Again, from my understanding, this would benefit people who are able to return to work, but the fact still remains: the many jobs which were previously around simply won't exist by July 31st, and as a result, this doesn't provide much stimulus to combat the forces we discussed earlier. Imagine a restaurant, for example. Let's say everything goes smoothly and they're able to reopen by July 31st. Let's even assume that demand is just as high as before, which is probably generous given that people are saving more than ever. Well, even if the restaurant can open and people want to eat there, the owners can't let as many people eat at the same time anymore without risking overcrowding. As a result, maybe they only need 3 waiters instead of 5, and maybe just 2 chefs instead of 3. So that's 3 jobs lost, which aren't likely to return soon. Now, I'm not in the business of politics, and I'm not going to comment on any specific policies either. Honestly, I'm not smart enough to really add to the conversation, but I do believe that the 5 factors we discussed earlier. Number 1, federal unemployment benefits ending on July 31st. Number 2, no second stimulus checks likely by this date. Number 3, evictions returning on July 25th. Number 4, student loan payments resuming in early October. And number 5, mortgage payments returning in late October. These are going to hit the average person hard. And when they do, it's unlikely that regular people will be turning to the stock market to risk their money. So if you're invested in the stock market, this could seriously impact you. As you probably know, there's been somewhat of a retail investor frenzy lately. Here, we can see the total number of stock positions at Robinhood. It took 2 years to grow from 5 million to 14 million, and then shot up from 17 million at the beginning of lockdown to over 30 million within just 2 months. And this isn't an isolated piece of data. As you know, I've been making a lot of videos recently about the retail investor frenzy, with people piling into the bankrupt companies like Hertz and JCPenney. And a big part of why people have been investing more comes from the stimulus checks they've received. This table shows us what people did with their first stimulus checks. For people earning between $35,000 per year and $50,000, investing into the stock market was the 3rd most common use of their money. For the segment above, this was the same. For those earning $100,000 to $150,000, investing was the 2nd highest use. And for those earning over $250,000 per year, it was the 7th most popular use. And I know what you're thinking here. Aren't retail investors a small portion of the market? How can they really have such a large impact? Well, as noted here, the Goldman Sachs basket of retail favourite stocks have vastly outperformed the broader S&P 500, not to mention most hedge fund indexes. In other words, the stocks which are usually most commonly invested into by retail investors, stocks like Tesla and Amazon, have risen the most because of retail investors. In fact, Rich Ross went as far as to say, take advantage of their relative inexperience, which creates opportunities for professional investors. So retail investors are so heavily invested into the market today that it can easily push stock prices around and even create opportunities for other investors. Now again, once we go back to these 5 factors that we have discussed throughout, all hitting the average retail investor in just a 3-month window, it seems unlikely to me at least that people will be investing or trading as much as they have done over the past few months, and hence this could result in an economic and stock market crash.
car industry is very dependent on tools, die, and machinery in order to manufacture their cars. But each one of these necessities for the car industry is experiencing a 1 to 3 month delay because of the Chinese shutdown of the manufacturing sector. Now this means that car companies will not be able to launch their new annual vehicles on time, therefore missing out on billions of dollars worth of sales. And also because people are being asked to stay inside, they're missing out on some wages, they're trying to be cautious and work from home if possible. Because of those things, we've seen an 80% drop in automotive sales in countries like China. And this effect trickles down. You see, if car companies are seeing a drop in sales and revenue, then so will its suppliers. And if the suppliers see a drop in revenue, then so will the raw industries that work with the suppliers. And this effect radiates to all other companies that are connected to the automotive industry. And what else happens when a company sees a drop in sales or revenue? Well, we tend to see things like layoffs or even bankruptcies. And those things lead to a higher unemployment rate, which would lead to less purchases being made by consumers, which would lead to less sales being made by businesses. And this cycle continues until the economy hits a low point like the Great Recession or the Great Depression. Now, keep in mind that this is just the automotive industry example that I'm giving. The drop in sales that I talked about will apply to virtually every other industry in the world, except the toilet paper industry, because that's actually manufactured in a bunch of different countries around the world. Yet sales have increased for some companies like KP Tissue by almost 50% in the last few weeks. So there is no toilet paper shortage, everyone. It's just a bunch of hoarders buying 100 rolls at a time, and large retailers just can't restock the shelves fast enough. Anyways, typically from the time that we begin to see a slowdown in sales from worldwide companies to the time where we experience massive layoffs, defaults on loans, and bankruptcies, it can be anywhere between 2 and 24 months. I mean, think about this. The Great Recession began in December of 2007, but it took until September of 2008 in order for the worst parts of the recession to begin to be felt, and it was in March of 2009 when things were at their worst. That's a period of about 15 months in order for the recession to hit rock bottom. So what I'm trying to say here is that even though we may not experience an economic downturn in the next few weeks, we will almost certainly experience some sort of negative consequences in the next 24 months. So the Great Recession might not be the best comparison for what we're going through today, because that was caused by a combination of banks, insurance companies, and investors that created massive flaws in the financial system. The most comparable economic downturn to the one that we are seeing today was probably the recession of 2001, except the one that we're going through today is on a much larger scale. You see, in 2001, there was a rapid drop in stock prices after a half-decade-long bull market. There was also a crisis that slowed down the world's economy, which was 9/11, and there was a temporary ban on air travel in many countries throughout the world. Now, these aren't the exact same as to what we're seeing today, but it is the most comparable recession in terms of causes. And in 2001, what we saw is that the effects of the recession caused an 8-month economic downturn and doubled the unemployment rate to about 6%. But again, the thing is that what we're seeing today is much more extreme than what we saw back then, because today we are seeing many more negative economic indicators. For example, today consumer debt is at a higher level than it was during the recession of even 2008, meaning that any economic downturn might cause people to miss payments on their debt and in turn create massive losses for lenders, similar to what happened in 2008. Today, stock market volatility, which is usually a sign of investors being uncertain about an incoming economic collapse, is actually at the exact same level as it was right before the 2008 recession, which was extremely high. There are also two giant industries right now in the airlines and the cruise lines that are actually on the brink of bankruptcy, and no one is really talking about this. In fact, I'm almost certain that if people aren't able to travel again in the next few weeks or couple months, then we will see at least one major airline go bankrupt or get bailed out. In fact, it might even be all of them. And what is strange is that this might be one of the only bailouts that I've 100% agreed with, because it's due to an unpredictable change in traveling laws and regulations and not due to the incompetence of the industry. In fact, if you want to know how bad airlines are getting hit right now, take WestJet, for example. They're a fairly big airline with 14,000 employees, but they are expected to lay off between 20 and 50% of their flight attendants in the next few weeks if air travel does not return back to normal. There was actually an internal memo sent to the WestJet union that said, "Our airline's well-being has become grave, overnight. And there's another industry titan in American Airlines that said it will be cutting down its international flights by 75%. There's also Air Canada that gets roughly 70% of their revenue from international and US flights, and those flights are either empty or just not happening right now. And because of this downturn in air travel, there have been spokespeople like Christoph Hannibal, who represents Air Transat, who have said, "We are currently assessing the impact on our operations and expect the government to help airlines and travel companies weather these extraordinary circumstances." And as I mentioned earlier, the airline industry is not the only industry getting hit right now. Of course, you probably heard about a lot of the other shutdowns, like the businesses that involve large gatherings of groups of people. These are the businesses like the NBA, NHL, MLB, MLS, concerts, comedy shows, conferences, and much more. And even though each one of these businesses is much smaller than some of the bigger industries that we've already talked about, having all of these industries take a hit at the same time will begin to add up in ways that you don't think about. I mean, for example, have you thought about the economic impact of shutting down the NBA? You might think that the only people who will get hurt are the players, the owners, maybe the broadcasters, but that isn't true. Because the people that will be most affected are the arena workers who are expecting to have a stable weekly paycheck, but all of a sudden have no source of income. Now, luckily, many NBA players and owners have offered to give some help to the arena workers by funding them until the NBA comes back. But the point here is that every single shutdown of a business will likely have an economic impact that most people aren't thinking of. And yes, there's even different kinds of companies that don't draw in large or dense crowds that are still shutting down for several weeks at a time. The best two examples are Nike and Apple, who have shut down all of their stores in hopes to stop the spread of the virus throughout the world. And even though these are big companies that will be able to get through the shutdown while still being able to pay all of its workers, there are still many businesses who are shutting down temporarily or who are limiting store hours who will be unable to pay their hourly workers their expected wage. And what about the stores and small businesses that do keep their doors open during this time? Well, this early data is pretty terrifying. Let's take the restaurant business, for example. So there are apps like Resy and OpenTable which are used to book tables at restaurants, and they're reporting that covers are down between 30 and 65% in areas like New York and Washington. And this one really hurts me personally because picture all of the mom and pop local restaurants and businesses that are just being able to get by and pay the bills, and all of a sudden this disease outbreak happens and they might go out of business because everyone is staying at home. So all of these points represent the case for an incoming recession. And there's a ton of other points that are tough to quantify, such as businesses losing productivity by having people work from home. There was a sharp drop in oil prices recently too, and there's a ton of other economic indicators that signal a really bad economy coming in the future. But this does not mean that a horrible recession is for sure coming. You see, there are ways to at least mitigate some of the short-term consequences of a recession. For example, one action that several countries have done, like Canada and the United States, is that they have set up a loan program where small business owners are able to take out interest-free loans in hopes to prevent their businesses from shutting down during the next 6 to 12 months. Another thing is, as mentioned earlier, using taxpayer money to help bail out core infrastructure companies such as airlines might help prevent large companies from going bankrupt. Now, I'm not saying to bail out every single large company, but core infrastructure ones, there's a good debate for actually doing that. Another tactic, for whatever reason that no one has mentioned so far, is the Federal Reserve is lending out $1.5 trillion. Yes, that was a trillion with a T. They're lending this money out to Wall Street and the big banks. Now, there is a complex reasoning behind this called the repo market, and that would take an entire video to explain properly, but here's a quick overview. The United States banks have taken out $1.5 trillion worth of loans in order to help get them through tough economic times where treasuries are less liquid. It's essentially a loan to help stabilize the market. Now, if the market does stabilize with this injection, that's a good thing, so the banks and market might not collapse. But if the market does not stabilize with this injection, all of a sudden, you will see a giant collapse on Wall Street, which was what happened in 2008. And if that didn't worry you enough, this method of lending to banks is kind of viewed as the last resort to help stabilize a market and prevent a collapse. Now, lastly, another thing that is done virtually every time there's an economic slowdown is a reduction in interest rates. This is a very simple way to make debt cheaper in hopes of promoting spending that will kickstart the economy. And typically what you see is that when times are going to be good, interest rates go up. And when times are going to be bad, interest rates go down. Now, initially when I recorded this video, I talked about how the Federal Reserve just did an emergency rate cut down to 1.25%. But in the last few minutes, they just did another emergency rate cut down to essentially 0%. That is something that you only saw during the deepest parts of the 2008 recession. And so when I initially recorded this, I was going to say that they didn't want to lower it down to 0% because they wanted to have one more bullet in the chamber to potentially help out the economy when things start to get really bad. But now they just used that last bullet unless they want to go to negative interest rates, which I don't know if they do. But wow, I can't believe that happened while recording this video. And even though these measures might help prevent some companies from going out of business or having to do mass layoffs, the one thing that can't be prevented is the slowdown of the economy that we have already experienced in the last few weeks. And this will likely continue for the foreseeable future. You see, governmental action can only get you so far during a recession. At the end of the day, the only real way that we can prevent or minimize this recession is to have life return, well, back to normal for the average person. But that might not happen for quite a while. So buckle up, be prepared, because we might be in for a tough one.
In a recent interview, Ray Dalio has come out and said that he thinks the 2020 crisis will be bigger than the one that we had in 2008, and it will be similar to the Great Depression in 1930. I want to let Dalio explain it though.
Well, I think you could look at this like a tsunami that's hit the virus itself and the social distancing, and then what are the consequences in terms of the wreckage when you look at it. And I think you have to think of that as incomes and balance sheets, you know. So it was a tremendous income hit, and then the balance sheets losses, and who has what savings and so on. And then how is that dealt with? And in order to understand that, you have to realize that there are these holes in income and the holes in the balance sheets. And then you have to realize that there is the production of money and credit. And who produces that money and credit? Okay, the money and credit comes in different flavors. There is US dollar money and credit. There is euro dollar money and credit. And so when you look at the world and you're seeing a situation that is the same as existed really in the 1930 to 45 period, in that now we're seeing the production of a lot of debt, a lot of borrowing by the government. We're seeing zero interest rates and not the traditional kind of monetary policy, but the producing of a lot of money and credit. So the Federal Reserve is buying the Treasury's debt, and the Treasury is getting that money to mostly Americans in some imperfect but remarkably large way. And the Europeans are doing the same in their way. That bank is a smaller bank because the world lives with about 70% dollars and only a small percent euro, and they will produce theirs for theirs. And there aren't many banks around the world. And so the rest of the world is going to have gaps, holes that won't be filled. So if you think about that and you say, American printing of money and the borrowing will leave us with a lot of debt and monetization. That's something interesting to talk about. And we need to talk about that. Who will pay these bills? And how will that be shared will be something we need to talk about. But you will know that you will get that money, and that the Europeans will get their versions of that money. But we are in a new world, and that world is most similar to the 1930 to 45 world, and a lot of the world will not get that money and credit.
So what you need to understand is at the moment, we currently have a lot of debt on our hands. I mean, as of 2020, that figure is sitting around $25.3 trillion. That's about 107% of GDP. We need to ask ourselves, with all of this debt on our hands, with all of this printing of money, who at the end of the day will pay the bill? How will this all turn out? And before you can answer these questions, you need to know how the economy works and the key patterns that we can see throughout history. I want to let Dalio explain it very simply.
If I can take a minute, I'd like to just paint a template for you that takes us, over the last 1,000 years, the things that have happened over and over again. There is one pattern that I'd like to convey. May I take a moment and do that?
What matters to you?
There are 4 things that are the driving forces of our economy and our lifestyle and wealth. And the first and most powerful is productivity, which comes from people learning and inventing and doing things well, just as Marco described. Okay? And it grows slowly. 1 or 2 or 3% a year, it grows slowly, and it's not volatile because knowledge isn't volatile, but it grows, and that raises our living standards over a period of time. Then there's a short-term debt cycle. The short-term debt cycle is, recessions and expansions and booms and recessions, that they last about 8-10 years. And then there's a long-term debt cycle. And that long-term debt cycle, which goes on about once every 50 to 75 years, is when you begin a new type of money and a new type of credit. That began in 1945. The New World Order, at the end of World War II, and with the Bretton Woods monetary system, created a new monetary system in 1945, a new money. So they wiped out pretty much the old money, or they largely disposed of it, and they began anew, and that's the New World Order, which was the American World Order, and we have seen it, and still 70% of the money and credit that exists in the economy is running by dollars. And what you have traditionally is the breakdown. And then the fourth influence is politics. And politics is largely how we deal with each other. And there's internal politics and there's external politics. The internal politics is, how do you deal with the wealth gap? How do you deal with the values gap? Do you have a common mission? Do we have an American dream that we can agree on and that we're pursuing that together? Or do you fight over wealth and so on? And so when you look at history, that's what revolutions are in their various ways. And there's always a revolution in one of these. Sometimes those are peaceful revolutions, and so sometimes they're disruptive. But it's a wealth shift that needs to take place. So the Roosevelt shifted policies and changed taxes and so on in that way. And then in other countries, there was the turning over democracy. Hitler came to power because of that gap. So how people deal with each other internally. There's also external politics. So that politics means between countries. And you have a situation when there's a rising power challenging existing power. There is competition and there is a risk of war. And so how they deal with each other, so that whether there's a greater good or whether they are fighting with each other, is the defining moment.
So what you need to understand is that right now, at least in the short-term debt cycle, it appears that we are coming to the end of that cycle. This is a graph of the Dow Jones history, which gives us a good indicator for the entire American market. As you can see, it's been 12 years and we've had that strong bull market run. But then, if you pull this graph back 70 to 80 years ago, we get a better look at the long-term debt cycle, which, as Dalio said, on average tends to last around 50 to 75 years. Now, it has been exactly 75 years since the start of this current long-term debt cycle that we are in, which started in 1945. That's a strong indicator that things might be about to change. But the question is, what market conditions can we expect in the future? Again, I'll go to Dalio. He thinks that we are in a similar situation to that of 1930 to 1945. Why? because the ingredients are exactly the same, with debt on our hands, low interest rates, the vast printing of money, etc. And the bad news is that this period wasn't exactly the most fun or profitable period to be in for investors. As you know, we had that Great Depression, and from then on, it was quite volatile. So now the question should move on to, what should we do with our investments during this time? Again, let's go to Dalio. He said the worst thing that one can do is think that they can time markets. So what the individual investor needs to do is know how to diversify well and in a balanced way. And for this, he created something which he called an all-weather portfolio. This portfolio is supposed to be able to weather any economic season and still do well. It accounts for 30% in stocks, and Dalio, he likes to use ETFs as his way of exposing himself to the stock market. ETFs in the USA, but also world ETFs. This way you can make sure you diversify your net worth through countries around the globe. Then it's 40% in long-term bonds and 15% in intermediate-term bonds. Also, you've got 7.5% in gold, which is another thing that Dalio alluded to recently. He says if you don't own gold, you know neither history nor economics. And lastly, 7.5% in commodities to finish off this diversified, balanced portfolio that, at least according to Dalio, should be able to weather through this economic storm.
A dollar crash and new world order is coming. Are you ready? Hi, I'm Roger Hamilton. Welcome to another episode of Entrepreneur TV. And on this episode, we are going to be talking about exactly when a dollar crash is going to happen, exactly how it's going to happen, why it's going to happen, and we're going to take a very data-driven approach to get there. We're also going to talk at the end about the 5 things you can do for both protection and profit as a result of this crash. But first of all, why am I even doing this video now? There are plenty of different videos out there about the dollar crash, both in terms of whether it's going to happen and also the fact that it's not going to happen. I'm going to give you a different perspective from the point of view of what we're seeing all around the world. As many of you know, we have businesses all over the world in Genius Group, in South Africa, in Australia, in Singapore, in Europe, and all of these different countries have seen massive swings against the US dollar ever since the crisis began. And just to have a look at this VIX index, this is known also as a fear index because it is measuring volatility and it's just gone up. It's doubled in the last couple of weeks. You can see that as the volatility goes up, so the US dollar goes up as people take their money out of the market. But what we're talking about here in the crash is something much bigger. And right now, the dollar crash is making the news as a result of Stephen Roach and what he's been saying. Stephen Roach wrote an opinion piece, which you can see here in Bloomberg, saying how the coming crash in the dollar will unfold. And he's since been talking about this in the news as well. This is what he just said to CNBC. The national savings rate is probably going to be deeper into negative territory than it has ever done for the United States or any leading economy in economic history. At the same time, America is walking away from globalization and is focused on decoupling itself from the rest of the world. That's a lethal combination. And if you're wondering who Stephen Roach is, he's one of the top economic experts in Asia and the former chairman of Morgan Stanley. Now, what Stephen says makes sense, but it's just another opinion, and that's really the problem with it. And like I said, I want to take a more data-driven approach to this, and so the person that I'm going to be referring to is billionaire Ray Dalio. Now, what Ray has done is he has started publishing chapter by chapter of his new book, The Changing World Order, on his LinkedIn page, and he's now up to chapter 4. And I'm going to give you the highlights of exactly what he's saying and what we need to prepare for. And in case you didn't know who Ray Dalio was, he was working on the floor of the New York Stock Exchange at the time when Nixon took the US dollar off the gold standard. That was in the early 1970s. And by the time he got to 1980s, he already has started figuring out that all economic cycles have waves. Most economists and even traders, they take waves which are 10 years, maybe even 50 years. But he started realizing that cycles even go up to 100 and 500 years. He turned his thinking into code, creating some of the very first trading algorithms, which allowed him to set up Bridgewater Associates, which by the time 2013 came around became the biggest hedge fund in the world. Today, Ray is actually worth $18 billion, and he's spending a lot of time going out there telling people and warning people about what's about to come. In Davos in January, before the crisis came, he famously said to CNBC, "Cash is trash." And why would he say that? Because cash already has lost so much of its value. So have a look at this for a moment. This is a graph from howmuch.net, which shows the purchasing power of $100 in 1913 and how that's worth only $3.87 today. That's a 97% drop in value. And in fact, if you look at it against an ounce of gold, $20.67 was what it would cost you for an ounce of gold back in 1913. Today, it's $1,737. That's a drop of 99% in the value of the dollar. Now you might be thinking, well, I'm still living, I'm still getting by, so like what's the big deal that it's dropped by 99%? And you wouldn't be wrong about that, because it's one thing if the value of the dollar goes down, but if things cost you more, but you're actually earning more as well, then the comparative difference you don't feel. If things were doubling in price, but at the same time you were earning double as much, then your affordability wouldn't actually change. Or similarly, if the value of the dollar was dropping against gold, just as they were in other countries, their currencies drop too, you also wouldn't be feeling the difference. But what we're talking about here is what happens when the dollar crashes against everything. That's when you suddenly realize you can't afford the things you could afford before, or you can't exchange against the things that you could exchange against before. So what does Ray say? He's not even saying what's coming as a crash. He's saying it's a complete collapse. And the reason he's saying that is because the US dollar has kept its value as a result of being the global reserve currency. That's about to change. In his introduction chapter, he talks about the fate of each of the global reserve currencies before the US dollar. And he says it is also the case that all reserve currencies in the past have ceased to be reserve currencies, often coming to traumatic ends for the countries that enjoyed this special privilege. So I also began to wonder whether, when, and why the dollar would decline as the world's leading reserve currency, and how that would change the world as we know it. In chapter 1, he actually shows the 4 empires, Dutch, British, American, and Chinese, and says these empires held the last 3 reserve currencies, the US now, the British before it, and the Dutch before that. China's included because it has risen to be the second most powerful empire country, and because it's so consistently powerful in most years prior to around 1850. But what you're going to see is he basically predicts that it's going to be China who ends up with the next reserve currency. He also shows a graph of the rise and decline of the big cycle, where you can see there are certain things like education, innovation, competitiveness, which all start to decline first, and the final thing that declines is the reserve status of the currency itself. Now, if you've been following Ray, you'll know that he's been comparing the current crisis very similar to the 1930 depressions. And Ray says, as previously explained, the last major period of destroying and restructuring happened in 1930 to 45, which led to the new period of building and the new world order that began in 1945 with the creation of a new global monetary system and a new American-dominated system of world governance. Now, most of us have spent our entire lifetime with just one reserve currency. But what's happened here is that Ray has gone all the way back and studied how the cycle repeats itself every time. In chapter 2, he talks about what the 6 stages of the cycle are. The first stage is hard money and almost no debt. Hard money is something like gold, which actually has intrinsic value. Second stage is when money becomes claims on the hard money, such as paper money. Third stage is increased debt, which actually is then built off that money. Then comes debt crisis, defaults, and devaluations. Next stage is fiat money, which actually then decouples totally from the hard money. And finally, a collapse and the start of a brand new cycle. Now, you can be skeptical about this because the government keeps on printing more trillions and trillions of dollars, and you might think, well, at this point, it still hasn't collapsed. But what Ray is saying is that this is not a matter of whether, it's a matter of when. In chapter 3, which is called The Changing Value of Money, he says printing and devaluing money is the easiest way out of a debt crisis. He says you are seeing these things happen now in response to the announcements of the sending out of large amounts of money and credit by central governments and central banks. He says all currencies have been devalued or died. And of the roughly 750 currencies that have existed since 1700, only about 20% remain. And of those that remain, all have been devalued. You can see here a graph that Ray's put in on how each of these reserve currencies have compared against gold. And really what we're waiting for right now is for the new reserve currency to get strong enough to take over from the US dollar. So what happened to the last 2 reserve currencies? For the Dutch, the collapse of the guilder was massive and relatively quick and taking place over less than a decade, with the actual circulation of guilders falling swiftly by the end of the Fourth Anglo-Dutch War. This collapse came as the Netherlands entered a steep decline as a world power, first losing a major war against the British and subsequently facing invasion on the continent from France. For the British, the decline was more gradual. It took 2 devaluations before it fully lost its reserve currency status. Many of those who continued to hold reserves in pounds did so due to political pressures, and their assets significantly underperformed US assets during the same time. Typically leading up to a country losing its reserve currency position, number 1, there's an already established loss of economic and political primacy. Number 2, there are large and growing debts that are monetized by the central bank printing money. Number 3, a weakening of the currency in a self-reinforcing run from the currency that can't be stopped. Now have a look at this graph from chapter 4 when he talks about the big cycle. This gives you an idea of where we are in the cycle as well. It starts with the New World Order, which was in the 1940s, peace, prosperity, productive debt growth, debt bubble, and big wealth gap, leading to the debt bust and economic downturn, which obviously happened in the 2000s, leading to printing money and credit, which has happened over the last 10 years. Revolutions and wars, we've still got that to look forward to, and then debt and political restructuring towards a new world order. Now, how long is it going to take for this to happen? Ray Dalio agrees with Stephen Roach. It's going to be somewhere in the region of 2 to 5 years. But that doesn't mean you shouldn't be preparing now. During the crisis, China has already launched the digital yuan. This is the very first central bank digital currency, and many people believe it's the digital yuan, which is China's focus at being the replacement to the US dollar. As a digital currency, it can bypass banks, it can be passed directly from one person to another and be fully tracked. It has zero transaction cost, and it can be transferred far faster than current fiat currency because it doesn't need a bank as a clearing agent. Now, whether or not you believe all this is going to happen or not, it's better to be safe than sorry. So here's 5 things that you can do right now to be able to protect yourself and profit from the coming crash. The first thing is to diversify your cash itself. There are many banks out there you can go to now that will actually set up multiple currency accounts. For both my companies and also personally, I have accounts in US dollars, in euros, in yen, in Australian dollars, and Singapore dollars. By splitting your cash, it allows you to make sure that if one starts to go down, then you're still hedging your money against those that might still be going up. The second thing is where your cash actually is stored. Do not be in a country where there's a chance that the banking system itself is going to collapse. Smaller companies with more stable banking systems actually are better than the larger countries which can have too much debt exposure. We've set up all of our accounts in Singapore because Singapore has been controlling not just the coronavirus, but actually its entire economic system all through this crisis. It's surprisingly easy to set up an account in Singapore or even set up a company in Singapore as well. As all you do, just Google it, look for it, and just don't assume that you have to keep all your money in your own country. The third thing, obviously, is to diversify into assets which are hedged against the dollar. That includes gold, silver, Bitcoin, and any asset where you know that if the dollar drops, that these assets are going to grow in value. The fourth step, even more so than those assets, are cash generating assets. As many of you know, right now we are focusing at an acquisition strategy where we are buying cash flow driven companies. And what that does is allow us to make sure no matter what's happening to asset values, we always are going to be growing our cash flow. And the final thing is debt itself. When you know the currency is going down, taking more debt actually is a good thing. If I have money in yuan and I have debt in US dollars and the US dollar drops against the yuan, it means relatively I owe less. And ultimately, with whatever strategy you choose, the most important thing is answering this question. Would I be okay if the US dollar halved in value? Once you've got a strategy where that works for you, then you can just get on with your life knowing that even with a crash, you're going to be okay. Everything I've done, everything we've done in the company has been set up for exactly that scenario. The way to be crisis proof is to know you're going to be okay in the crisis, and the way to be crash proof is to know you're going to be okay in a crash. I'm with Ray Dalio on this. I believe this is going to be a 2 or 3 year thing before we see this happening. Maybe faster, maybe slower. And if it doesn't happen at all, well, we've lost nothing. Always better to be prepared for the worst and hoping for the best.
Okay, so that was just some deep insights there. I did add some extra stuff there based on some of the information that Ray Dalio looks like a very insightful individual puts out to the world. So then the dream vision shifted, and it shifted to this location, and it started to show coat of arms a little bit closer on this location, and then closer and closer again, and then it showed parts of the US dollar, and then a earth grid, and then a horned planet, and then closer again. If we look here, we'll take a look at this really quick. So this has to do with the Hampton Palace, and that's what was shown. And it has to do with that a countdown to 2022. One of the reasons for this is that I'll talk about in a little bit, but the belief is that there's a countdown from 1943 down to 2022. You see some of the clock running down here, and that it was connected with the shift in power from Britain over to America, and 2022 minus 40 gives you 1982, and 2022 minus 7 gives you 2015. That's important because this is connected to also the Washington Monument, and they believe that the Washington Monument was the end clock, and they were rushing to get their plan in place by the end of 2016, and they're still scrambling to figure out what happened in 2016. They believe they had all their ducks in a row, but it didn't turn out to be that. But anyway, you can check into that more. So then it shifted back to the Washington Monument, and the Washington Monument has a connection also to the Great Pyramid of Giza. The Great Pyramid of Giza is a countdown clock. It kind of it matches with the heavens and the various things that occur there. It's connected into. And if we actually look here, I'll show you. This is where it interconnects with. See there, 2016. They believe that would be done by 2016, the great work that they were working on. But again, the year 2016, they still can't understand what happened, why everything they had planned for didn't take shape. So take another look here, and you can see that that the various layouts that they were trying to use the energy towards Washington DC and the Washington Monument. Again, they thought it was all geared towards 2016. And again, you can see that they were overlaying the Great Pyramid and believed that they could harness the energy that was laid out on Washington DC. But they started to go too deep into things, and they started to believe that they had to harness more and more energy and do other things to achieve what they were trying to do, which was their world order. So basically trying to take over America and wreck the country from inside out. But as you can see, within the dream vision, lightning was starting to swirl around the Washington Monument. So this is a big thing, and it's getting closer, and it's getting ready to send a message to those who have tried to destroy America. And as you can see, all interconnected with 2016, again connected to the Hampton Palace. See, right, where they believed everything was they would be in full power in 2016, that they had everything in place. They even projected everything out through the Olympics in 2012, the open and closing ceremonies. And again, so now the lightning is getting closer and closer to the Washington Monument. And as you can see, see if we can get in closer. Let's see, here we go. That they were constantly trying to make sure that 2016 was the year where they would believe they would have everything in place, 2016. And by 2016, they would have everything in place. But now they're focused in on 2022 to try and have everything in place. So, but they made a big mistake, and the lightning is coming, the power is coming, and that's what the dream vision is showing, is that something altered or something changed in 2016. And again, they're still trying to figure out their plans, but something very powerful is coming, and it's not going to be good for these I don't know, These people are stupid. Anyway, 2016, right? Again, 2016, they believed they would have their order in place, and they're trying to figure out how to get it back on track for 2022. But something very, very powerful is coming against their stupid plans. These people are sick, man. They're trying to use ancient gods of ancient times to pull energy into grids and call on these gods of the ancient days to get their plan in place by 2022 now that they missed 2016. See, 2016, they're trying to use various methods to bring their plans into place by 2022, but they really don't know what they've done. They're after being sent a sign on June 2nd, 2020 that something very, very powerful is coming. So again, I'll play this video one more time. And if you haven't seen part 1, go check it out. So then the dream vision shifted to the pyramids, and a lot of powerful things going on again. So if you think about what's happening here, it's connected to the Washington Monument, Hampton Court Palace, and the Great Pyramid. And they were using the Great Pyramid to create amazing things. Like the founding fathers of America were creating geometric timelines to allow people of America to know the times that they're in. But certain organizations, if you will, were infiltrated, and they're now using sacrifices, if you will, or various nefarious things they're doing right now to use the ley lines against America, and to use the structures that were actually built for the betterment of not only America but the world. And they're trying to use ancient gods to call in their power, but they've made a drastic mistake. And the fact that on July 2nd, 2020, that the Washington Monument was struck with such powerful lightning, I really don't think people comprehend what's after being sent into America, and what's going to uproot all these. People are sick. Anyway, so it's all connected then to the Great Pyramids within the dream vision, and the mathematical amazement of one of the 7 wonders of the world. And the Great Pyramid then is also connected to Israel and the kings and queens chambers. And right now I'm still under the flow of another dream vision that's happening, that I'm trying to put it all down here. I'm releasing all this information as fast as possible, as fast as possible. And so then again, he's showing the pyramid up close and the overlay, and it's also connected to the Fibonacci sequence, which is connected to pi, and it all goes back to the understanding of measurement. And that's another thing that will be in some other stuff that's coming up. And again, the overlay with Israel, and how Israel, the Great Pyramid, Washington Monument, the Hampton Court Palace are all interchanged with a timeline countdown clock that's happening. And again, what they were trying to do was they were trying to be in power in 2016. They wanted power in 2016 because they believed that if they had the power, the rod of power in 2016, that they would be they would have everything. But again, now they've shifted their attention to 2022, and they're after being sent a sign, a massive sign, that they're after really annoying one of the gods, if you will, calling on the wrong god for what they're doing, and that god is coming with such power that they will not comprehend what's coming at them. So again, here's their sign they were given, that something from the heavens very powerful is coming at them. These people are sick. So that now ends fourth wave of energy incoming on July 10th, 2020, and absolutely amazing to see that fourth wave coming. The world has been kind of like flipped a little bit since the beginning of the fourth wave to now, and you could say that a great awakening is happening. And as I said, the dream vision had to do with real estate, housing market, or real estate, stock market, US stock market, global economy, all these things, and it's all most likely a part of the 2022 plan to destroy America or take it down or break the global economy or something. So out of nowhere, then you have this massive release of energy on July 2nd or June 2nd, 2020, as a warning, as a sign, as something very powerful hitting the Washington Monument. And again, if you haven't watched video 1 on this dream vision, I highly recommend it to give you kind of some context. And as I said, they couldn't understand what happened in 2016, so they start doing more and more nefarious bad things on the planet and causing more and more innocents to be lost. And they have really annoyed the heavens. So now the heavens is coming. So yeah, very good.